This is Nightly Business Report with Bill Griffith and Sue Herrera.
Dow 27,000. The market hits a new milestone on optimism over an interest rate cut, making it even trickier to invest at these lofty levels.
New prognosis. The White House kills its prescription drug rebate rule, sending insurance stocks higher. But will Big Pharma be the next target?
The real world inflation is more than just numbers. It could mean paying more for your coffee. Those stories and more tonight on Nightly Business Report for Thursday, July 11th.
And we do bid you a good evening, everybody, and welcome. Well, the Dow and the S&P both closed at record highs today. In fact, the blue chip average, as you heard, rallied past 27,000 for the first time ever. Investors cheered a second day of Capitol Hill testimony from Fed Chair Jerome Powell, where he signaled a potential cut in interest rates later this month. Healthcare stocks also contributed to the rise. We will explain why in a moment, but first, the closing numbers for this Thursday, with the industrial average gaining 227 points to 27,088. The Nasdaq was down 6, the S&P added 6. Bob Pisani has more on the record-setting day.
Another day, another market milestone. Investors cheered comments from the Federal Reserve signaling that a rate cut is likely just around the corner. The Dow crossed above 27,000 for the first time today, and the S&P 500 moved just to the edge of 3,000, a fraction of a point below it. Close enough. What a difference 5 years makes. The S&P has moved 50% in less than 5 years, from 2,000 in August of 2014 to 3,000 essentially this week. But the market today is very different than it was back in 2014. Investors have played favorites in a very big way. Big tech and FANG names dominate among the winners, including Amazon, Netflix, Microsoft, Facebook, Apple. Amazon and Netflix are up almost 500% each since the S&P crossed 2,000 5 years ago. Chip stocks have also skyrocketed. Nvidia, AMD, both up more than 700% in the last 5 years. We've seen big gains from Broadcom and Xilinx as well. There's an even broader trend. The biggest companies, they just keep getting bigger and bigger, particularly tech-related companies. Visa and MasterCard, those are fintech companies. Cisco is another example. There's a few non-tech outliers like United Health and Home Depot that have been big outperformers, but not many of them. Then there are the outright losers. Energy stocks down big, which is no surprise. Oil was $100 5 years ago, and it's $60 today. The other big losing sector is retailers, which includes stocks like Macy's and Gap, down big. So what does it mean that a handful of tech titans have come to dominate the market? It's all about growth. Technology is where the growth is, and growth is hard to find globally, so investors are willing to pay up almost anything for growth wherever they can find it. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So with the market at new highs, what should you do right now? Joining us to talk about that is Patrick Chovanec. He is the Chief Strategist at Silvercrest Asset Management. Welcome, Patrick. Nice to see you again.
Hello.
Is it decidedly more difficult to navigate the market at new highs?
Well, right now, the economy is a lot more wobbly than the market seems to be. You know, that's why the Fed is talking about cutting rates, which is something that the market's excited about. But the economy is slowing, and it could slow further. Now, you know, it could pull through. So I wouldn't go so far as to say that the market's riding for a fall, but there could be bumpier days ahead.
Yeah, I mean, that's the big conundrum we're facing right now. Jerome Powell just told us that the global economy is slowing down, and it's taking our economy with it. Earnings will be coming out starting next week, and certainly expectations are not very high for those, but yet here we sit at all-time highs today. Is this simply a stock market that's on a sugar high because of the lower rates?
Yeah, no, because ironically, this is not a market that is gorging on risk. When you look at what's really expensive in the market today, it's actually your safe harbors. Treasuries are returning 2%, which is barely above inflation. So the problem is that while, you know, if you look and you don't like the risk that you see out there, and you want to take money off the table, where do you put it? Mm-hmm. It's actually more expensive to try to hide from risk than it is to actually ride it out right now.
So if you're a longer-term investor, do you just kind of stay put in this market but expect some volatility?
I think that's really the best choice that you have. I do think that you need to realistically assess how much risk you can afford. You know, if the market were down 30% in a year because there was a recession, how would you cope? You should always be thinking about that. But you should also be thinking about what you're giving up by simply going and hiding under a rock for a year or two. And I think you're giving up quite a bit, both in terms of short-term and long-term gains if you go and do that.
Patrick, thank you so much. Patrick Chavanek with Silvercrest Asset Management.
We mentioned that rally in healthcare stocks that helped lift the Dow above 27,000. Here's why. The Trump administration today withdrew that proposal that would have eliminated rebates from government drug plans. That boosted the shares of insurers like United Healthcare, Cigna, and CVS. But it also raised the possibility of new restrictions on drug makers, which pressured that group today. Meg Terrell has details for us.
The Trump administration claimed its rule on drug rebates had the potential to be the most sweeping change to how Americans' drugs are priced at the pharmacy counter ever. Today, it abandoned the plan. Here's what it was aiming to do. For Medicare insurance plans, beneficiaries pay both a monthly premium and, when they get a prescription, they pay an out-of-pocket cost at the pharmacy counter. So how is it determined how much they pay for their medicines? Well, the drug company sets a list price, and pharmacy benefits managers then negotiate a rebate on that drug. But insurance copays for drugs are often based on the list price, not the price after the rebate. Right now, the PBMs and insurance companies take that rebate and spread it across their plan beneficiaries to lower premiums for everyone. What the Trump administration rule sought to do was instead apply those rebates directly to the price of drugs at the pharmacy counter. So the patient being prescribed the drug could pay a lower price at the pharmacy. But because the rebates wouldn't be spread across beneficiaries, premiums for everyone could go up. And that, according to Capitol Street's Ipsita Smolinski, presented a political problem.
The concern was that premiums going up for Medicare beneficiaries, these are those over 65 and who vote, would probably not like to see their premiums go up for 2020 or for 2021.
While the Trump administration rule would have applied just to Medicare, there had been concern it could have led to changes in rebates in employer-provided insurance as well, Smolinski says. And in those commercial plans, rebates contribute hundreds of millions of dollars in profit to pharmacy benefits managers, according to Leerink. That's why those stocks soared today. But drug company stocks sank. That's because Trump's not expected to give up on the issue of drug prices and may in fact double down on efforts that could hit pharma's bottom line. Investors now are trying to parse comments the president made last week about a most favored nation clause.
For years and years, other nations paid less for drugs than we do, sometimes by 60, 70%. We're going to be, and we're working on it right now, we're working on a favored nation clause where we pay whatever the lowest nation's price is. Why should other nations, like Canada, but why should other nations pay much less than us?
A source close to the administration tells me that's how the White House refers to a rule it's already proposed, tying the prices of some Medicare drugs to an international average. Trump said yesterday another announcement on drug prices is expected this week. For Nightly Business Report, I'm Meg Terrell.
The Fed chair was back on Capitol Hill today, where he sent strong signals that the central bank is ready and able to cut interest rates this month. Steve Leisman has more from Washington.
Fed Chairman Jay Powell's visit to Capitol Hill on day two was a lot like day one, where he affirmed the market's view that rate cuts are likely coming at the end of July. But he also provided maybe a little context for how much the Fed might cut in July or even beyond.
You don't want to get behind the curve and let inflation drop well below 2%, because what happens is you get into this unhealthy dynamic potentially where lower expected inflation gets baked into interest rates, which means lower interest rates, which means less room for the central bank to react. And that becomes a self-reinforcing thing. We've seen it in Japan. We're now seeing it in Europe. And that's why we think it's so important that we defend our 2% inflation goal here in the United States.
A Federal Reserve that's concerned about being behind the curve like Europe and Japan might be one that cuts more deeply than it otherwise might, trying to use what bullets it has to reduce rates more effectively. Stocks liked what Powell said today, in part because it removed any potential risk that he might reverse himself from day one. Also, Powell tended to ignore stronger economic data, both the inflation data and stronger jobless claims numbers, which fell by 13,000. That means the economic data may not matter all that much if the concerns are trade uncertainties, global economic weakness, and inflation that's been running persistently below the Fed's 2% target. Then the data may not deter the Federal Reserve from what looks like an inevitable rate cut at the end of this month. For Nightly Business Report, I'm Steve Leisman in Washington.
And Steve just mentioned today's inflation data, where consumer prices posted their biggest gain in nearly 1.5 years in June. According to the Labor Department, the so-called core consumer price index, which excludes food and energy, rose by 0.3%. That was more than expected, and it followed 4 straight monthly gains. Now, food and energy are often excluded because those prices are considered volatile on a month-to-month basis. But it's also the stuff we pay for every day, including things like coffee.
It's increasing, like everything's increasing because salaries are increasing, but it goes with the, it's like gas, you need it.
As a college student, I think it's a little bit like yikes when you realize that, oh, it's like $5 for like this much coffee. So it's a little like you have to cut back.
Yeah, price went up significantly. I remember when coffee was 50 cents a cup.
A medium at Dunkin' Donuts is $2.85. If that goes to like $4 and something, I don't think I would do it.
I really haven't paid attention to the pricing. It's kind of a necessary evil. I love coffee, and whatever goes up, I'm just going to deal with it.
So some people are seeing inflated prices at their local coffee shops, but the government data and the Fed say that inflation remains tame. So who has it right? Bob Brusca is with us tonight. He's chief economist at Fact and Opinion Economics. Bob, first of all, welcome. Thanks for joining us tonight.
Thank you.
You know, there's that old saying that people will always complain about the price of bread and gasoline, and in this case, coffee. But is there an especially glaring disconnect these days between what we are paying on an everyday basis and these tame inflation data reports that we get from the government and the Fed?
I don't think so. I think the problem, though, is that people tend to focus on prices when they go up. And I think the other problem is that it's a low inflation environment. People's incomes don't go up very much. So when your income isn't going up very much and prices start going up, you really begin to notice it, and it hurts.
So, Bob, what impact do you think it will have? I mean, we heard some people say that if prices went up too much, that they would stop buying. Other people said they need their coffee, they're going to keep buying. So if indeed it is more noticeable because wages are not going up as fast as they used to, what impact might that have?
Well, people can buy beans, grind them at home, and make coffee and carry it to work, and it'll be a lot cheaper.
A very practical advice there from Bob Brusca. At this point, why is inflation, statistically speaking, from the Federal Reserve and the government as tame as it is right now? You know, Jerome Powell made a rather profound statement today when he said that low unemployment no longer leads to high inflation, which is what we were taught in economics school. Why is that the case now?
Yeah, this unemployment inflation trade-off known as the Phillips curve is pretty flat. You say the Phillips curve is dead. You have low inflation in Japan, you have low inflation in Europe, and we have low prices being generated every day out of China, and we have a lot of technology, and we all carry around cell phones that help us to check prices, and all of this really tends to keep prices very low. There's a lot of competition. There's low prices elsewhere in the world, low inflation elsewhere in the world, and incomes aren't going up, and so people check their phones a lot to double-check prices when they spend money, and that keeps prices in line.
So after Mr. Powell's testimony today, do you think they cut by 25 or 50?
I'd be real surprised if they did 50, Sue. I think you're going to get 25, and I think they're going to try to keep the other 25 in their pocket. I don't see the case for 50.
Bob Brusca with Fact and Opinion Economics. Good to see you, Robert. Thanks for joining us tonight.
Good to see you, too.
Thanks.
It is time to take a look at some of today's upgrades and downgrades. Goldman Sachs launched coverage of the retail sector, which included a buy rating on Walmart. The analyst cites the retailer's aggressive strategy that could drive strong sales growth. The price target is $123. The stock rose a fraction to $113.92. Weight Watchers was upgraded to neutral from underweight at JP Morgan. The firm cites stabilizing subscriber growth trends. The price target is $22. The stock gained 8% to $23.67.
Discount retailer Dillard's was upgraded to neutral from underperform at Wedbush Securities. The analyst cited stabilizing promotions at that company. Price target $62. The stock rose 4% today to $62.85. Allstate was downgraded to underperform from neutral at Credit Suisse, with the analysts saying that the insurer's margins are under pressure due to weather and competition. Price target $94. That stock fell 1% today to 103.15.
Still ahead, tech titans may face a future with new rules.
I'm Julie Borston in Sun Valley, Idaho, where a range of tech CEOs are at the Allen & Co. conference, and regulation of those tech giants is in focus. That's coming up on the Nightly Business Report.
We got a report today that said the federal budget deficit widened by more than 20% in the first 9 months of the fiscal year. Federal spending outpaced government tax receipts due in part to higher spending on military and interest on the debt, coupled with the tax cuts for corporations.
The International Monetary Fund is forecasting more economic pain for the Eurozone. The organization says the region faces anemic growth stemming from trade tensions, Brexit, and Italy's high debt levels. The IMF also backed the European Central Bank's plans for fresh stimulus.
We told you last night that the White House was planning to launch an investigation into a tax on technology companies imposed by the French government. And in fact, earlier today, French lawmakers did approve the so-called digital tax, setting up a fight with Washington. Kayla Tausche has our details.
The White House is fighting back as France moves closer to a new tax on tech companies. The U.S. Trade Representative launching an investigation that could result in new tariffs on France for the fees it says unfairly target U.S. companies for being global leaders. The proposal is named for Google, Amazon, Facebook, and Apple, and would see about 30 digital services companies pay an extra 3% on their revenue in France. It's retroactive to cover this year. French Finance Minister Bruno Le Maire defended the move and challenged the U.S. Treasury Secretary, the G7, and OECD countries to reach an agreement.
As soon as there will be an international solution at the OECD level, France will withdraw its national taxation.
Experts say this fight is just beginning.
The bigger question is what will happen in the next several months, how other countries outside of the U.S. will react to this, whether or not it will inspire them to implement their own digital taxes, or whether or not it will be a warning not to implement these types of taxes until more international measures have moved forward.
The White House's counterpunch has been praised in Washington, from leading Republican lawmakers and business groups traditionally critical of tariffs to both hawks and doves advising the president. The irony, even as they hit back against new fees on tech overseas, regulators are ramping up their own scrutiny here at home. For Nightly Business Report, I'm Kayla Tausche in Washington.
Delta is seeing some tailwinds, and that's where we begin tonight's market focus. The airline raised its 2019 profit outlook thanks to strong demand. The carrier posted record revenue and raised its dividend. And unlike its competitors, Delta does not operate the Boeing 737 MAX.
We do not fly the MAX, and clearly there was a benefit for the airline in the quarter. I don't think there was a significant benefit. Certainly it's not explaining the results we're seeing. I don't know when the plane's going to come back. As we've seen, it's taken longer than any of us expected to see it return to service. It's not going to be in place for the third quarter, maybe sometime into the fourth quarter. We don't have a crystal ball on that.
The stock rose more than 1% to 60.16. T-Mobile and Sprint are reportedly expected to extend their July 29th deadline for their $26 billion merger. The Wall Street Journal reports both wireless carriers discuss ownership issues related to Dish Network. This would be the second deadline extension. T-Mobile shares dropped a fraction to $78.26. Sprint shares fell nearly 3.5% to $6.91. And shares of Fastenal missed both earnings and revenue estimates. The wholesale distributor of industrial and construction supplies says the trade war with China impacted its numbers, specifically higher tariffs on imported goods that were produced in China. The stock fell nearly 3% to $30.36.
Shares of Grubhub fell today on fears of new regulations. The New York Post says that New York State is reportedly looking to limit the fees that food delivery companies can charge and require them to be listed on liquor licenses when they deliver for restaurants that do serve alcohol. Grubhub shares fell nearly 4% as a result today to 74 even. Ford and Volkswagen reportedly plan to announce a new joint venture on electric and autonomous vehicles. That deal would allow both companies to share intellectual property and hardware. A formal announcement is expected tomorrow. Volkswagen does not trade here in the U.S., but Ford shares were up a fraction to 10.19. And Boeing announced its 737 program manager, Eric Lindblad, is retiring after serving in that post for less than a year. He was, however, a 35-year veteran at the company. Mark Jenks will now be taking over the reins of that troubled program, which has suffered from the grounding of the 737 MAX aircraft. The stock was up nearly 2% today to $3.59 even. And after the bell, genetics company Illumina warned that its fiscal second quarter revenue is going to be weaker than expected. Company cited weakness in its direct-to-consumer market, among other things. Shares initially dropped in after hours tonight. They closed the regular session today down more than 2% at 363.66.
A bit earlier in our program, we mentioned Washington's increased scrutiny of the tech sector. The potential wave of regulation was top of mind in Sun Valley, Idaho, where tech titans are meeting. Julia Borston spoke to them.
Apple's Tim Cook, Facebook's Sheryl Sandberg, and Twitter CFO Ned Siegel walking the paths here in Sun Valley, along with former Yahoo CEO Jerry Yang and Uber CEO Dara Khosrowshahi, big tech is out in force. And so is talk of regulating the giants, ahead of antitrust hearings on Capitol Hill next week. Sam Altman, who funded Y Combinator, which funds and advises early-stage startups, says he thinks there's no question that tech regulation is needed, but that breaking up the likes of Facebook or Google would be much harder.
The companies have gotten so big and so powerful and so intertwined, but I think when I talk to most of them, they sort of actively want regulation. Like, we're all sort of in uncharted territory, and I think either we figure out how to regulate more quickly and more effectively than we have in the past, or we end up in a world where at some point we have to do it in a very clumsy way.
Former Twitter CEO Dick Costolo says antitrust and privacy issues shouldn't be conflated.
It's not just the fact that companies are big that should cause them to be regulated. The size of the company doesn't have really any impact on the kinds of things it might be doing. It's those specific things that companies are doing with data, the way they're managing it or mismanaging it.
The question is what laws would best protect consumers without giving an unfair advantage to the giants that can better afford regulation. And Verizon CEO Hans Vestberg notes how hard it is for regulation to keep up with innovation.
I think the technology is moving so fast. So if you do regulation, it's just moving so fast that it's hard. So I think it's up to responsible leaders.
While Mark Zuckerberg, who's tried to dodge the cameras here, says he does not want to regulate Facebook himself. We'll see how much the tech companies here enforce changes around the likes of privacy to avoid drastic government action. For Nightly Business Report, I'm Julia Borston in Sun Valley, Idaho.
And coming up, the smallest state in the country is facing some big economic challenges. Here's what we're watching tomorrow. The Producer Price Index will be providing investors with additional information on inflation pressures within the economy. We will see if the trade war with China is having an impact on its economy when Beijing releases import and export numbers for the month of June. And the president of the Chicago Fed speaks on economic conditions and monetary policy. That's what we're watching for Friday.
Wall Street banks are lending less money to farmers. According to Reuters, which cites FDIC data, agricultural loans of the nation's top 30 banks fell about 17% between the peak in 2015 and March of this year. Banks had increased their exposure to the rural Midwest following the financial crisis, in part because farmers had plenty of income and collateral. But the retreat in lending comes as farmers' incomes decline.
We told you yesterday that Virginia was ranked the top state for business in CNBC's annual survey due to the quality of its workforce and educational system. But there are 50 states. That means that somebody had to come in last. So tonight, Scott Cohn takes us to the survey's worst state for business, Rhode Island.
For a little state, Rhode Island has big problems. But to hear the governor tell it, the worst is over.
We have stopped the decline. We have stopped the decline, and working together, we have ignited a comeback of this great state and our economy.
The comeback has yet to show up in the numbers, near the bottom for business friendliness, cost of doing business, economy, and still at the bottom for infrastructure. Fixing that has been a priority for Governor Gina Raimondo.
There's more road work going on in this state than at any time in our lifetime.
Funded by a controversial program to charge tolls on trucks, not surprisingly unpopular with truckers like Michael Collins.
We need to kill this cancer in this state because it's going to spread like wildfire to other states.
Thank you.
The governor wrote her plan to re-election last year, but it still faces some skepticism.
Got to do something as long as the money actually does go to the roads.
The issue is going to be passed on to consumers, but somebody has to pay for it.
The administration says in its first 3 years, there's been $1.5 billion worth of new road construction, 100 miles of roads paved, and nearly 200 bridges repaired. Unemployment is now in line with the national average, and 30 businesses have moved to the state. But school test scores are low, and economic growth is among the lowest in the country. More proof that a comeback, no matter how hard you try, doesn't happen overnight. For Nightly Business Report, I'm Scott Cohn.
Before we go, here's a look at the day's final numbers on Wall Street. The Dow gained 227 points to close above 27,000. The Nasdaq was down 6, and the S&P 500 added 6 to finish at a record. And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.